Um, well, I hope everyone had a meaningful time on the floor. I got to hold the baby the whole time, so I'm feeling pretty great about the day. Um, it is 10:40, and our next witness is coming at 11:15. And so we have like 30 minutes to talk through some stuff. And I'd love to start with pre-K, if that's okay with folks. It's hard to have a discussion when no one's looking. Okay. Hey, Mark, we're going to talk about pre-K.
Okay,
Cool.
Jim, we're talking about pre-K.
okay. Just trying to complete a test. Thank you very much, Madam Chair.
Hi, Carolyn. We're talking about pre-K. So the topic is huge and a small part of what we're doing in the grand scheme of all the things we're doing. We spend some time trying to understand how things fit together in current law. And we're ideally need to make some decisions about future law. And I'm wondering if folks have thoughts on sort of how we should navigate that conversation, and then what further testimony people are interested in with regards to it. Where I'm leaning is to put essentially like a hypothetical scenario on the table for us to work through in the form of like something like legislative language. So we can just have something tangible that we say, okay, if we make the weight one, what are the impacts of it? Because that seems like an easier way to have the conversation than all of the sort of hypothetical implications that we were talking through the other day. If I do that, I want to be clear, it's not a policy proposal I'm making. Because generally when language goes on the table, it's perceived as the chair's policy proposal. Is that, okay.
Yeah.
So I'm going to put a hypothetical on the table, probably next week, if that sounds like a good idea to folks. And it'll be something like a weight of one, essentially treating 4-year-olds, maybe 3-year-olds as if they're kindergartners. Yeah.
Why a one? I thought the way it is now, it's a 0.46.
Well, we know that 0.46 makes no sense. And one is what kindergartners are. And then so we would walk through from there.
Right.
What do you mean by 0.46 makes no sense?
Well, it was my understanding a totally arbitrary decision. But I think you were more involved when it became 0.46 than I was. So if you have more info on that, be happy
I think
to.
it was just tied to the particular way we are constructing it. So when you say one, are you assuming that there are other changes in how the program is?
Yeah, and then we'd have to figure out what those other changes that we need to make are.
And is that what we do, or is that what Ed, this is where I'm confused, because that feels like Ed policy.
Mhm. I think we'd have to name what sort of decisions still need to be made. That would be other committees' jurisdiction as we're working through it. And what are ours?
And I would just observe that for me, how you weight it is very dependent on what that policy decision is.
Yeah. We could also say, what if we weight it? What are the policy decisions that need to be made?
That might be a good way to type.
Can you
say that again?
If we weight it, what are the other decisions that need to be made? And then we can send those decisions off to the 2 committees they'd most likely go to.
I like the idea.
And by other decisions to be made, you're talking about the school district, what do they have to pay for that we don't have on the table yet?
So that would be one thing. It would also be, or would we change the number of hours that the state is officially covering?
Less than 10.
Things like that. How is it delivered? Those would be decisions we would then send off and say, like, here are the implications of those decisions. Do you want to make them? And then it would come back to us again. I think, yeah, go ahead.
Okay, what about these instances where communities are not running their preschool inside the school, they're farming it out to private.
We would have to say like, okay, so in that scenario, what are the decisions that need to be made from there? What are the fiscal implications of it? So when when the entire JFO staff team came in and talked through, you know, the implications for individual fair families, the implications for centers, the implications for schools. It was a little, for me, it was a little abstracted. And so I wonder if we said, if we make a weight of 1, if we change to a weight of 1, what would be the implications for this party, and this party in these different scenarios? It seems like an easier way to understand the decisions we need to make. I don't know, Mark?
So, again, I'm trying to get my head around all of it. So the one would be that $15,033 figure going,
From the foundation formula?
yeah.
Maybe, yeah. With weights, yeah. It would be treating them like kindergartners.
Yeah, I've got a lot to understand about the whole process and.
Does it seem easier to understand if we make it like that much more tangible, though?
Yeah,
Okay. Yeah.
I just want to say, I love it. Because then we can say, oh, and what happens with the families? What happens with the centers? What happens with the schools? What are their incentives to do this and that? So I like it. It gives us a starting point.
Okay.
And then I like that we can say to the policy committees, you
Mhm.
think about X, we're not going to make that choice.
Okay.
I think this is a case where universal state policy has very, very different implications in different regions of the state.
Yeah.
So for example, schools aren't deciding to farm this out. This is a mandatory voucher program. And we actually closed some rural public school programs because if you lose enough scale, you actually can't operate. So that's just a fiscal decision that they're making locally. It's a very different dynamic in remote rural, near rural, and urban. It's a very different impact. So I think we should look at different regions of the state.
Yep.
And I think we should also look at the price to the state overall of different policy choices, which is very, very different from the price to local communities, because the impact locally, what makes sense financially locally, may actually cost the state more overall.
Yes.
And I think we have been a little slack about paying attention to that.
Yeah, I think at some point we need to hear from tax on where that payroll deduction tax is and what's the balance and how much is going to schools.
Sometimes when I do regions of the state, purposely pick regions that are not well represented in this room, and then sometimes pick regions that are very well represented in this room, so we're like hearing from our people. Do folks have a preference on that? Carol?
About regions. I am thinking that maybe we have different weights and different straight up.
Okay, that is, you're taking a leap.
Yeah, I am leaping.
Okay.
Yeah, you're talking about, looking at different regions.
Yeah,
And what impacts in one place is going to be completely different from another
Yes.
place. So, all right, fine, then how would we break out the regions to look at them,
Mhm.
depending on that impact? And then look at what 1.0 does in each of the regions. I mean, maybe that.
Are you looking at me? I mean, I would support taking the names off the regions. I think
Yeah,
they're
we can do
prototypes, and I think we need to look objectively at this as a policy choice, independent of how we defend our own regions. And I also think this is a sector, it's actually interesting how parallel it is to our education conversation, where there are different expectations of the providers in different sectors. And so I think when you talk about using the same weight, but you're fundamentally paying for different services in different contexts. I don't know if it's a regional issue around weight. I think it's a context issue around weight.
Okay. So does that work with, say something?
Yeah.
Does that work with figuring out prototype regions, or do you do context? Something context.
Well, that would be the same conversation, but I'm not saying it's my town or Carol's town. I'm
No.
saying, here's a hypothetical example that might exist in Vermont. It might be a real data. We often use, when we.
And Julia's done that for us a bunch
Julie
of
does that
times.
a lot. She does, and that's great, because then we don't get personally invested.
I was always grateful on sort of summer task forces. When we were like really sort of getting into spreadsheet wars a little bit, that like Wyndham County was always like on the 5th page. So I would tend to like not look at my own district. And folks from Addison County were always in a hard spot because like they couldn't help but immediately look to their own district. Are there any, like, as we're sort of putting together testimony for that, are there other things that immediately come to mind for folks? Yeah.
In terms of house ed, have you had conversations with Chair Conlon? Because about whether they're looking at different approaches to this. I mean, one approach that's been used in other places that have tried to do what we've done at scale is instead of having this entirely of individual verification, individual this, that, and the other, they have market managers who actually contract for the needed capacity. So that, I mean, what we do know about a subsidy-based approach is it tends to drive inflation in the sector, but may not necessarily create supply. And that's kind of where we are right now. The way people negotiate around that is they don't do a demand-driven system, they do a market-managed system. Is that something we're even talking about?
I have not talked to the 2 other chairs about this in like a couple weeks. We talked about it before the session started, but we haven't talked about it since the session started. So I'm going to check in with them about like for like as we've all had more time in committee to figure out how we want to divide it up better.
That's a, like I say, that makes me think of different people who've approached me and said, and yesterday at lunch, somebody, well, I asked CPAs at the CPA lunch, do you hear anything or do you see anything different in households where they are over a 595% of poverty and need childcare? And the one CPA said, yes, I see one person in the 2-person household dropping out of the
Mhm.
workforce because they can't afford what is now an inflated childcare price, even higher than it was before. And then somebody else, someone else said that when you have 2 healthcare workers, and we have to have healthcare workers.
Do you mean doctors?
No, not necessarily, maybe 2 physical therapists,
SPAs.
or, yeah,
Not like an LNA though, in your, when you say
No.
healthcare workers.
No.
Thank you. Okay.
it could, I don't know, maybe there's an LNA married to a surgeon,
Okay.
and that just over the line, 75,000, whatever it is. And now there's a person who has to make a decision based on childcare costs, what to do. Not only do I not like that, but even a bigger, broader economic picture is we're trying to help people by giving scholarship help and all kinds of help, reducing what they owe to pay back loans and so forth. And then when we have them, if they are driven out of the workforce for however many years, this is, you can't solve this. I'm looking at you because you're the chair. This is a situation that's not a good situation. So when I hear the subsidy can drive inflation, I think that happened.
Yeah. I think we need to be narrow enough that we're really only focused on pre-K.
Yeah.
Make sure that nothing we do to change anything in pre-K is having a negative impact on birth to 3. But I don't think we don't have the capacity to go fully into rehashing the
Right.
birth to 3 conversation.
Okay,
Just in the interest of finishing anything.
fine. I will
Okay.
not bring it up again. I just want
Yeah, no, it's, yeah.
to see.
Yeah.
Valid.
And I've been slammed, not in this room, but for this comment before, but I'm committed to it. Because one person in the household is dropping out of the workforce to be at home. It doesn't, that's not a bad decision. Sometimes people make that
Yeah.
decision for the good of their family, for
Mhm.
some personal reasons or for whatever. So anyway, keep in mind that, because I know I'm twice as old as anybody else around here.
really don't think that's. I mean, maybe Teddy, but I don't think you're twice as old as anyone else.
Seriously. But
I don't think it's old fashioned. Personally, I want people to make those decisions based on what's best for their family and not what they feel absolutely forced to do, like at risk of going hungry, right? That's,
I
yes,
agree.
yeah, yeah.
Oh,
One thing that hasn't come up yet is the overlap with the child independent care credit, which we're going to need to make decisions about in the context of the federal changes as well. Because that credit is passing through. So that right now, if we link up to federal tax law, that credit's going to go up.
That was actually part of my question.
Oh.
Could we also, I think we need to model the impact of some of the proposals we've been talking about. So if you move pre-K into for 4-year-olds into schools, which is one of the things people have been kicking around, it actually potentially could have an impact on the business model for the 0 to 3.
Yeah.
But on the other hand, if you're not taking the 3-year-olds, you might offset some of that. We just don't know. We don't know how that interacts with the credit. So we have to do some pretty significant modeling. The other thing is there are different cost structures in different settings that we ought to be modeling the impact of. And there are also huge costs associated with dual regulation. And if we remove dual regulation, what we're talking about is avoidable costs. It is much harder to model, but it is very, very real. And I know that many schools, and one of the reasons we lost after school was there was a change made that no one paid any attention to that required schools that ran after school programs that were childcares to get dual regulated. They were just like, forget it, we're done. And so we just collapsed in 3 weeks.
And I think yes, absolutely. I think there's a question of whether or not dual regulation is our jurisdiction or another committee's jurisdiction. And it's interesting because even the question of dual regulation, we have 2 committees, right? So.
But it's driven, but it's leadership committees and it's driven by money.
Absolutely,
Like
yeah.
if the ed fund is only used for school-based programs, then you can end the dual regulation. If you're using ed fund to support private childcare providers, then you have to have dual regulation.
And if you don't have dual regulation, I think you then wind up with just an important question that needs to be solved of like the transition from sort of families making a transition from one system to another, which is something that.
Anyway,
Absolutely.
and the rules are not consistent now. There are different rules in different settings, even with dual regulation.
The thing that, part of it isn't in our arena, I guess, but I was looking at the Building Bright Futures education outcomes in Vermont,
Mhm.
which concerned me. We didn't have an opportunity to talk about them.
Mhm.
I'm sure there's a tie-in to the amount of money spent, maybe, and the outcomes, because, I'd certainly like to understand the outcomes a little better, what they mean. I mean, it doesn't look good to me. And, what kind of money we're spending, how are we spending it to get those proficiency ratings? It's not good to me.
I do think that's outside of our jurisdiction. And because it's less because to understand what sort of quality and adequacy ratings like measurement looks like is actually like an incredibly deeply complex issue because like every region prioritizes and measures something else to some degree.
Again, I guess at the end of the day.
You're like, what are we getting for our money?
A whole bunch more money.
Yeah. Totally.
I have to understand whether or not it's gonna be worth it.
But I'm sorry, I came in late. Did you talk about trying to identify the actual cost of?
Yes,
okay.
we talked about the cost to the state and the cost to communities and the cost to schools and yes.
It's interesting to look at through all the reports and varies anywhere from $10,000 to $14,000 for the cost of pre-K. Delivered in the public setting, but our tuition amount is only $3,800 for the
And that's for, right, and like how many hours do each of those things
Exactly.
equate to? Yeah.
Thank you for pointing that out, because some of those programs are full-time programs, they're just not weighted for it and they're eating it
Right.
out of their budget. So that's often used as a comparison. You cannot, this is apples to oranges. And I thought that slide on performance was so irresponsible. I do think that we can look at impact of investments, but you do it using the data that you use. And I could design a test that everybody in this room would fail, and I could design a test that everybody in this room would pass. You can't compare proficiency rates across assessments like that. It's just not done. But we did have data at one point where you can look at dosage in pre-kindergarten and look at, for kids who had different rates of exposure by different demographics, what was the impact on third grade performance, and look at the bump. And that has been done, but no one's done that modeling in 2 years that I'm aware of.
10 years?
I don't have, yeah, it was done in 2014.
Okay, thank you.
Do the schools have any better accounting that they had years ago where every report says it's impossible to figure out what the total cost is for pre-K because of coding, because of different accounting
So what
systems?
Building Bright Futures, I think mentioned sort of in passing, is that they received this pre-K grant from the feds, and they are going to use a portion of that grant to, I mean, on some level, someone could really drive around to each district and create their, like, it's not, we don't have that many districts that it would be such an incredible lift to get this data. And so they need to, they're going to use part of that grant to actually just like firmly answer the question.
But you've got to control, I mean, some of our pre-kindergartens have fully trained qualified teachers, some of them don't. And unless you're controlling for all those variables, it's really hard to know what's making the difference or whether we're even seeing a difference. So we just don't know, because our implementation did not collect baseline data, and we did not have consistent expectations for the same designation.
Even
And you're
the lack
just,
of
you're talking about cost, not quality measures.
Costs, I'm talking about the Uniform Chart of Accounts, which still isn't implemented equally across the system.
We don't have a consistent, they're having issues with the e-finance system. They should. I mean, I don't know why they're not using the chart of accounts, because they agree on it.
It's not huge. It's not new.
Anything else on this? Okay. Yeah,
Sorry. I really think we need to take seriously the potential loss of CPAP subsidies. I mean, I think we need to look at the,
like the loss from the feds.
yes, there has been some expression of intentionality about ending that program. If that program is ended, that's a loss of money. It's actually not as much money as people think it is. I think it's only about 15 million. And we probably put 15 million into administration just because we chose to do a very complicated compensatory model. So that if we do lose that money, there might be some thinking now about what happens if we do to rethink the system.
Is that the Head Start money or other?
It's a
separate money.
We may lose Head Start too.
But it is separate money from Head Start. So CCFAP in Vermont, which is childcare financial assistance, some of it is federal dollars in a pot. And then we add general fund dollars to the pot, and we add the payroll tax dollars to the pot. It's more complicated than that, but that's like the basic outline. And so if the federal money went away, how would things change? Head Start money is like more focused and slightly differently managed.
But it's a risk. We made a policy choice as a state to treat Head Starts as a standalone pre-kindergarten for the state funding as well. The risk is it creates an incentive to have programs that are highly economically disadvantaged and other programs that aren't. But
And that's not-
it's not, and that's
It's not true all over the state.
not true all over the state, but it is in some places. My point is those are the most vulnerable programs right now. And so part of our conversation has to be, how do we protect those kids? Because those are actually the kids for whom investment in pre-kindergarten makes the most difference. So we have to be chewing gum and walking here.
Ultimately, our goal is to really come up with a weight.
And the rules that would be attached to that weight the questions about the rules that would be attached to that weight. So if we make a weight, so when we make weights for the K-12 system, there's an assumption of, you know,
What the basis and what the services are.
yes.
Yeah.
And so that would need to be attached to pre-K, and some of those decisions we can make here, and some of them we would need to send off to other committees. Yeah.
Yeah, thank you. Remembering a comment that Andy Colby made downstairs, in our other room, when we were talking about weights,
Oh, yeah,
original weights.
I missed that room.
And she said, me too, in the seating accidents,
Good room.
but, she said that the original weights weren't based on empirical data.
Mhm.
They were just kind of made up. And so now this discussion is, instrumental on trying to figure out where we're going, because essentially what I'm picking up from around the room is we have a variety of ways to apply empirical data, and we haven't settled on it yet. At least that's what it seems to me. And so I'm waiting to hear some consensus emerge around the table, and I haven't heard it yet. And that's just facts on the ground. That's not a disparaging remark about anybody. It's just, there's a lot to consider before we settle on something. That's all.
And I think one thing that is convenient timing wise is if we put sort of standards attached to it, and the suggestion of a weight, then it can be validated with the contractor that's going to look at the weights.
Is that Tammy Volpe?
I don't know if the contract's signed.
They haven't figured it out yet.
Last
Can you
last
tell
week
us about the
JFO.
Contracting. I'm excited. I was thinking we
Yeah.
need this to be done.
So someone, maybe Julia Richter, talked about it in the chair last week, the week before.
Yeah.
Right? Is that familiar to anyone?
It's
Okay,
December,
okay, great.
but
Okay,
I
cool.
Know exactly what.
So they sent out an RFP based on language in Act 73, and they received a bunch of proposals, and they evaluated the proposals, and I think they're in the middle of contracting for it. And so we don't know who it is because they're in the middle of contracting.
Someone
Someone's about to have a
with lot of
contract signed.
expertise
Yes.
Is going to look at this.
They're going to look at all of the weights to sort of revalidate them, since the ones that we put in Act 73 were based on older data.
Will they specifically do a lot of work on this one? I was thinking no.
So they couldn't, given our existing rules and system. And so we need to give them a little more fodder to be working with.
You mean that we're gonna talk about this session and then they'll do more work over the summer or
Yes.
more direction?
Yeah, so if we can make pre-K more consistent, then they'll have more to work with.
Yeah.
Right now, it's too disparate.
So, and who would, what role does the education committee have in that? What role do we have in that?
I think when we go a little further down this road that we just described.
Yeah.
Well, we can name the pieces that still need to be figured out and answered that are outside of our jurisdiction. We can
Okay.
pass those off to the two committees.
So.
Or five, I don't know, maybe the Commerce Committee needs to get involved, I have no idea.
We're doing, so we just described, which I thought was great. That will be used by whoever's going to be contracted to do the,
Yeah, they're gonna look at whatever we have in statute.
yeah.
Yeah.
Are you expecting to pass a bill on this?
I was-
in the Session?
I was hoping so, yeah.
So then they'll look at that and then they'll say, okay, well, here's the weight based on that bill, or will they say, like, that's a good start, but really, this is what we think?
I feel like I've reached the limit of my ability to predict the future.
All right.
Okay.
I'm just trying to. Okay.
Our witness has arrived. I just want to do a few other things. So we now have a committee bill number on miscellaneous tax. When we do things that are sort of like smaller pieces, like the healthcare IT sunset, I'm gonna try to, Search is gonna try to label them as sort of within miscellaneous and then miscellaneous tax on our agenda. And ask folks, like, really, if you do have something small that is revenue neutral, that would fit into that bill, just like bring it to the table so we can be collecting things as we go along. For instance, the bill that we heard about the local option tax this morning, right? Like, who is the gov ops liaison? You're the gov ops liaison. Can you just keep an eye on that with Representative Walker for us? Thank you.
What's the bill number for the tax miscellaneous tax bill?
It's a draft. It's a draft request right now. We don't have.
260727 is our miscellaneous tax bill. And Representative Walker's bill, 487. I think we're gonna hear from Maura now unless anyone has anything else. Okay. Are you joining the Zoom, Maura?
I am. I also should have released a sort of like that.
It's really absolutely fine. Did you want the time while you were early to get yourself settled?
My testimony. No, I'm okay. I mean, that's never happened.
No.
Never.
No.
It's a little early in the session for it, though. Thanks for joining us.
Morning.
Hi. So folks, we are switching gears slowly. I invited Maura Collins in from VHFA to talk about a tax credit that might need some renewal. This is something that would go into the miscellaneous tax bill. And the floor is yours. Thank you.
Thank you very much. Hi, all. I'm Maura Collins. I am the Executive Director of the Vermont Housing Finance Agency. You know that we're a 51-year-old organization that has mortgages and funds the creation of rental housing. And about 11 years ago, well, let me even step back farther. In the late 80s, the federal government created a federal tax credit, and it has been wildly successful, creating millions of homes, affordable rentals all across the nation. And about 9,000 of them are in Vermont, housing very low income Vermonters. Smartly, the legislature in 2000 saw what the federal government was doing with their tax credit. And the legislature in 2000 said, we should have a state tax credit. And you all created one, and that too has been wildly successful, and I'd be happy to talk about it. It has been creating rental housing since 2000. You were ahead of your time because now when I go to conferences, states are realizing that tax credits are a good way of funding housing, and they're all starting up, not all, but there's more than a half dozen. There's probably 8 states now looking at creating state tax credit programs, to which I'm like, please, people, we've been doing this for 25 years and it's excellent. In your wisdom, your collective, I don't know how long you've been here, but in 2000, it was created for rental housing. In 2009, you got really smart and you said, let's build some for sale homes that are affordable to people. And so that's been happening for many years. In 2013, it was right after Tropical Storm Irene, you all expanded that homeownership credit to include the repair and renovation and purchase of manufactured homes that we could buy, old inefficient manufactured homes, largely by Riversides, and relocate them and have them be highly efficient. And in 2014, starting for 2015, you all expanded the program again to allow VHFA to sell these tax credits so that we could fund a down payment assistance program. I call it DPA, but it's down payment assistance. In 2014, like today, having a down payment is a big burden and barrier. And renting at the prices we see now and being able to save up, ideally 20%, but let's be honest, 5% to put down just so a bank will work with you and you can get mortgage insurance for the rest, is really hard. And so this gives you up to $10,000 to buy your first home. Your first home. We don't do, this is just for first-time home buyers. So, that's saying that we have $2 million a year to build affordable rental. Look at this. I don't even have to look at my notes. So, So VHFA's program has been around for those 11 years. We've been selling tax credits. There was always going to be a sunset to this because it was designed to be a revolving loan fund. This is what we want. Because let me explain to you how it works, and it makes sense that when we give people $10,000, we actually don't lose $10,000. Every year we've been selling these tax credits. Actually, let me tell you what that is. Banks have deposits. Let's say I'm a bank and I have $1 million of other people's money. I actually have to pay a bank franchise fee on that deposit. And that's I'm going to call it a tax. You probably wouldn't, but a fee. They want to not pay that. So they're going to buy these tax credits and invest in affordable housing in this way. And therefore they don't have to pay so much on that tax. That's the tax credit part, which is why, yes, I'm asking for this to go into miscellaneous tax. So they give VHFA about $1.1 million a year is how much cash we're having to put into this program. What we do is we take that $1-ish million and work with our participating lenders who have our mortgage program. And if you get a VHFA mortgage through your participating lender, could be a mortgage company, a credit union, a bank, then they'll say, oh, look at your income, look at your purchase price. This all qualifies for VHFA. That's great. Oh, you're a first timer. We can give you up to $10,000. Look, because you don't have enough down payment already. And that becomes what we call a silent second mortgage. It's a 0% subordinated loan, and you don't make any payments. You don't do anything about it until you refinance, because VHFA doesn't do refinances. So if you have the kind of equity that you can pull equity out and refinance, great, but you can now pay us back. Thank you very much. Or if you move or sell or die or whatever, we get paid back the $5,000 or $10,000 that we gave you. I say 5 because when we started the program, we were giving people 5,000. Home prices have gone up. We did increase it to 10,000 a few years ago. So that's how it works. I'm going to tell you in a minute. So not only do we have the tax credits that we're selling every year and we're handing out that money, but over time, people refinance, they move, things happen. And so we also are getting repayments on the program. This has been a very effective tool, and I will go quickly because, I could talk about this forever, but we have hit 249 of our towns. I know, but I'm also a New Yorker, so I talk fast. Why would we want people to become homeowners? I want to be very clear. Don't think everyone should be. Don't think it's always the right time for everyone to be a homeowner. I am not like silver bullet. Everyone needs to follow one path to their housing solutions. But I do think that having opportunities along the rung of the ladder is important. And why do I think that homeownership is important? It's because it addresses a wealth gap that we have in this country and in this state. You see here, this is national information, that homeowners' net worth is about $400,000, whereas a renter's median is $10,000. So when you exclude the home, which is an important factor here we're talking about, take that out of the mix, you still have 78% of homeowners who have some kind of appreciating asset, meaning they can be hard at work laboring, but there's something earning money for them quietly in the background that they can benefit from, whereas less than half of renters have that kind of passive income. And we're not even talking about the home's value. Here we're talking about the home's value. Look at this chart. You can see that the equity that people have in real estate is just going up and up and up, which is good. When people have equity in their homes, they have financial stability. I'm not saying that they shouldn't have equity, but we want more people to be able to reach in and gain such equity.
Just on this chart, what are the shaded bars?
Recessions.
And is there recession?
Yeah. So the realtors have data, again, national, that show this year, lots of news a few months ago when their latest report came out. Look at the orange bottom line here. The average age of a first-time home buyer has hit 40 years old. It was 31 years old just 10 years ago. Why should we care? Well, besides those of us who have kids living in our basement, and it's getting a little old to have them still there at 40. Additionally, the whole model of a 30-year fixed rate mortgage and how it all works is that the idea, some of us may remember, I'm actually a little young for this mantra, but I know it, which is you're supposed to have your house paid off by the time you retire. Now, people don't do that, and there's financial reasons why that may not even be smart, but that was the idea, was that you could live on Social Security, you could have a fixed income, you could not have earnings income at that time because you didn't have one of your biggest housing costs at the time. You paid off your mortgage. Well, if you're not becoming a homeowner until you're 40, add 30 onto that. Tell me where your financial position is and how that's working for you. So we do I would like to get back where first-time home buyers are early 30s, late 20s. I mean, that we really would like to move back, but late 20s was back in the 80s here. So even 30s I'd take. So this chart tells you about VHFA's average customer. I don't know about all homeowners. No one tells me their income if they don't have to, but these people have to. So this shows that people who got our DPA, our down payment assistance through this program versus the people who didn't, still worthy mortgage holders, wonderful people. But you can see that the people who get this assistance are buying cheaper homes with lower mortgages. They have lower incomes. They have to borrow more. They have less of a down payment. That's what loan to value is. They're having more of a mortgage in that regard. They have lower closing costs, probably because some of that's PTT and it's set by the purchase price. A lot of those costs are actually quite fixed. They have lower credit scores. They're younger, bigger households and things like that. So who are we helping? This program in the Wayback Time Machine was actually really championed by the Lake Champlain Chamber of Commerce. And it got started in both this committee, because this is where you do tax credits, but in the Commerce Committee. It was seen as a real economic development tool. There's a lot of conversation about employers who are clamoring to have their workers be able to buy a home because they thought that they would be less transient and it would be a more stable workforce. So we started asking people, where do you work when you get a mortgage? We don't always do that, but for this program we do, and that data has not been burdensome. And you can see here what kinds of industries we are serving through this program, as well as the median wage of folks. You can also see the actual employers listed here, the top 10. State of Vermont is the state's largest employer. I'm going to give you that, but it is a bit outsized compared to the other employers that we see and who we're helping. It's a nice spread of types of employers and who is being seen.
Wellington feels very random on that.
Sometimes I think we all know how it goes. When you know of a program and you talk about it at the water cooler in the lunchroom, people go, oh, well, I'm going to do that too. I mean, this is good advertising. So what have we done? We have, again, run this program for the last 11 years. And I said, it's like 1.1 million a year that we're putting out there. And we have helped over 2,100 households already. 63% of them still live in that house and have that mortgage that we gave them. So I like to point that out because I know those are still Vermonters who are paying taxes and working and doing economic benefits in the state. So that $11 million that we've invested in those folks is still here and supporting Vermonters. Those folks, when we look at what they bought their house for, whenever it was, and then we just generically say in that town, how much have prices risen? So we roughly could estimate how much equity that household has now. It's an average of $78,000 per household. So we gave them $5,000 if it was which was long ago, or $10,000, and it magic turned into $78,000 that you all didn't have to foot the bill for. Additionally, another 500 people might still be Vermonters living in their homes because they refinanced and didn't go anywhere, but I don't really know. Like they also could have died or moved or something else. But those 500 people paid us back. That was $3 million that we took back, that we re-lent out. So those folks, their homes appreciate an average of $50,000. Still great, maybe because it was a shorter time period. So if you add up the 2,100 folks and our rough estimate of what kind of equity we're talking about, this investment of this program for the last 10 years, which is about $1 million a year, has generated over $137 million of wealth. And that was through calendar year 2024, because I couldn't bring it up to today's dollars in this moment, but
Is that what you were gonna do if we'd given you 5 more?
no, no, I'm good. I'm not. So and this is wealth creation for folks that they can do what they want with. You may not like what they do with it, but I think a lot of us know what we do with our home is equity. One, we just have financial stability. We don't even touch it, but it helps our credit scores. It helps us know that if times get tough, we have that equity we can tap into. Some of us have needed to tap into it. We've got to send our kids to college. We got to invest in a business. We want to use that wealth and take advantage of it.
I think this is wonderful. I'm curious, you're showing us the success of your organization. How many failures have you had with all these funds that have come before?
It's an excellent question. I'm not prepared for, but I can get it for you. There have been some where people, foreclosure has happened. Yep. I feel very confident that it is such a low number. It will be shocking because VHFA has also put some money into this program, and we just haven't we haven't had to backfill for such losses, but I would like to follow up with you on it because I really can't tell you the number off the top of my head. Yeah. Yep. I also, somewhat relatedly, some of the success of why we don't see a lot of losses is that we do require pre-purchase education counseling that comes with this. And so we do feel like our borrowers are well educated and informed, and VHFA does not do any predatory lending. We only do a 30-year fixed rate and all that. So I do think that we have a good profile in that regard.
You don't have to go back to the slide, but on the previous slide, there was the credit score
Yep.
box. Do you have a credit score threshold for
Yes.
accident? What?
Yeah. 680.
To that point, you have experienced good repayment because you're underwriting each loan individually with some pretty strict standards.
Yeah, we're a good lender. Yep. Yep. And we've a relationship, we fund the homeownership centers in the state. There's 5 of them. They cover the entire state. It's the network of nonprofits. They double as the nonprofits that do housing development in your area a lot of times. So you'd know them as Wyndham Housing Trust and Champlain Housing Trust and others. They also have homeownership centers, and so we fund them and try to, if someone is not yet credit worthy or something like that, then they will work with them to hopefully get them there at some point.
So if someone comes to you with 670, you can work with them to try and get that.
I just want to be clear, we don't work with them, but we fund the homeownership centers to work with them. And then, yes, that's the goal. And usually it's a matter of then another year or something, and hopefully they work that out.
And does that get reviewed at all? Like, have you been 680 forever?
We've been for a long time, and a lot of that has to do with the secondary market, and that we will securitize these and have them go to Freddie and Fannie. And so honestly, we don't pick that number. We are using Freddie and Fannie standards for good pricing. Yeah.
Percent Hickley?
And do you also have construction standards? I mean, things like that, central heat, all these.
We use
qualifications?
Freddie and Fannie's. We don't have any overlay. We try not to have overlays above what other people tell us we have to have because they're good and they're enough.
Okay.
But yes, there are. Absolute, like you have to have water and sewer. Yeah. So roughly, we've been helping about 150 households a year with this. I want to be clear, this happens through the mortgage process. So you don't come to VHFA, we're not prioritizing applications, we're not looking at the need and saying you need it more than I need it, whatever. It is just happening when you go to your mortgage company, your credit union, your bank, who's a participating lender. And you get a VHFA mortgage and they say, oh, if you're getting VHFA and you're first timer, then you're eligible if you need it. And it all happens. That's how the state gets away with offering this program for 0 admin fees. We don't take anything for this, okay? Because it's we're leveraging the mortgage closing process that happens anywhere. Trust me, there's enough lawyers involved. We don't need more. So there's an extra paper or two to sign as a part of the closing process. There's a, what is it, $6 a page recording fee that we cover, but otherwise that's it. So we don't have the ability to pick the winners and losers in this program the way it's been designed. So I keep saying 11 years selling these tax credits. This current fiscal year of FY26 was the last year we could sell the tax credits. That now we've sold them. We have money right now. The program is still open. Make sure everyone knows. But last summer, our lenders can confirm that we had to ratchet back the program because the repayment part wasn't keeping up. And I'm going to show you some charts in a second about that. So as the repayments slowed down, we had to shrink the credit box of who is eligible. And we want people to have some money in the bank when they buy a home. We want to set them up for success. So, but we also have an asset limit, meaning you can't have $50,000 in the bank and then tell us that you need 10,000 of the state's money when you could have put your money to that down payment, okay? But we did allow people to have $30,000 because we're thinking, well, a roof would be 20, and we want people to have some cushion. So their bank account balances, their assets could be non-retirement, $30,000. We shrunk that to $20,000, not because we want people to be more financially precarious, but because we needed to shrink who was eligible because we were running low on money. Lenders do not like or want programs that open and close. It's not the way their world works. They can't handle it and they get very upset. So they would rather you curtail a program by characteristics. With the repayments being as slow as they are right now, I'm anticipating that we will need to somehow close the credit box to serve approximately 40 households a year. I don't know how I would do that. Please don't ask me what my ideas are because the lenders would freak out if I start spitballing it here. I might close the program for a year and amass enough repayments and then reopen it. We could get creative, but instead, before I have to do that, let's be honest, I'm coming here and asking if you could put $350,000 of this DPA tax credit into miscellaneous tax for the next 5 years. So we have 5 more years to sell the credit. And then I'm hoping repayments are enough and the capital of the revolving loan fund is enough to be sustainable. Let me tell you what that looks like though, because it's 5-year tax credit. So I'm going to hurt your brains in a minute.
I was hoping you had this chart, which you usually have first.
I do. It's the final one. I like to charm you all for a few minutes and then make you think really hard about complicated things. First off, the chart on the left here is national. It's just showing you that total movers is dropping everywhere. We're down to 8%. If you haven't read the book Stuck by Yanni Applebaum, that's the next one. I saw you guys passing around Abundance last year. Let's assign that to the book group because it really can trace just about all of our nation's shortcomings on the fact that we used to be a nation of tremendous economic mobility and how unique that was and how we could move to cities and jobs and that was a very unique prospect. And now we are stuck and that is limiting our economic and other upward mobility. The chart on the right is from this down payment program. Just look at the green bars. What this is telling you is that for the first 7 years of the program, that some of these people paid us back in year 2. They only had our money for 2 years. Why? Well, probably they're trying to avoid PMI, maybe the job change they didn't expect. Well, it's not a lot of people, but some of the folks paid us back in year 2. And you can see that as time goes on to year 3, 4, 5, more people are paying us back because more people are likely to move or refinance the longer they're there. I mean, mortgages, the rule of thumb used to be, I need to see if this is still true, but mortgages really, they're 30 years, but they really only are outstanding for about 7. You know, they just, very few of us have a mortgage, the same mortgage for 30 years. And actually, if anyone does right now, I'm concerned because you used to be able to get a 3% rate and you wanted to get that when you could have. So anyway, you can see in the early years that the green bars show that we were getting paid back. The orange bar shows what's been going on lately, which you see, we're not getting paid back, even though these people have had our money for 5 years. This is another way of showing the same thing. The line tells you what the average interest rates were for the year. And you can see in 2021, they dropped below 3%. And that green bar is telling you that we collected over $800,000 in repayments. Like, makes sense. We don't do refis, so they're going to pay us back when they refinance. But as you see that those interest rates get high and stay high, you see that the repayments are stalling. This is why I don't have the churn and we're a little stuck. I already told you that the amount of DPA has fluctuated. I'll point out to you that during the pandemic, everyone wanted everyone to take action. And so what this box is showing you is, I need to resize that graph. I'm sorry, those dates don't show up well. From 2020 to 2023, we did increase all the way up to $15,000 how much we'd give, but only for low income Vermonters. We did have an income differential. So in that box, it's both 2020, 2023. But it's telling you that if you earned more than 80% of the median income, you only got 10 grand. And if you earn less than 80% of median, you could get 15 grand. That was very short-lived because then we started running out of money. And so you can see on the pie chart, we did not a lot of those bigger loans. There's the chart. So this is a 5-year tax credit, which means that when I'm asking for $350,000, it means that the bank, if they choose to buy it, they're going to take 350 and multiply it by 5 and give us that much money because they get to write off $350,000 every year for 5 years. So someone help me, 350 times 5 is that much money they would give us, but you're too smart for your own good. So it's that much money. And then they would discount it a little bit because of the time value of money. They're not able to take that tax credit for 4 or 5 years and they could have invested and earned on it in the meantime. So there is a small discount. We've kept our pricing over 90 cents on the dollar though. So I feel very good about that. It's a very, very good tax credit. So what you see on this chart gets a little confusing, but you see a column for FY26, which is where we are today, and you see a row for 2026. And that's telling you that this year, what hit the state's financials was actually a $1.25 million hit, because it wasn't just the $250,000 we sold this year, but it was the second year of last year's and the third year the year before and all that. So you have to look at it cumulatively. So this year, we didn't cost you any extra money in that bottom green row. But next year, if we have our way, we're asking for an increase from 250 to 350, and that's because we're now giving people $10,000. And so we are hoping that this will be more sustainable and we don't have to come back to you anytime soon. And there will be $1 million hit to the state budget because of tax credits we've already sold and you've already approved. And please don't hold that against me because that's already done. But if we get to sell tax credits, then we would add 350 in the green row to the hit on the state's budget. Next year, we'd have another year of selling those tax credits. And I'm asking for the ability to sell this for 5 years. And it's a 5-year tax credit, which is why I need this visual to show you that there's a tail on it. We'll stop selling the credits in FY31, but you will see a financial impact through FY35 because of years 2, 3, 4, 5 of these credits. You can see in the green row what the annual impact on the state budget would be. I'm going to be bold and call it modest. If you looked, the total impact, if you added up that whole row, it would be $8.75 million. Spread over the 9 years means that's less than $1 million a year. It's $972,000 a year. You'd be helping these households generate $137 million of wealth with this investment. Welcome your question.
So a couple, I know it's a commitment for 5 years to sell, so it's about, what do you get, about 1.5 million to sell the 350? Yeah, for 5 years. You need the full 8.5 million?
I think I do. So first off, in statute, and it's always been set up as a 5-year tax credit. Could you change it to a 1-year tax credit? The downtown tax credit is a 1-year tax credit. But I still need the same amount of money to help people, so I'm gonna have my ask go from 350 to whatever 350 times 5 is, and I'm gonna need more money. But you could swallow your medicine faster and then have the impact be just over 5 fiscal years and not have that tail, but it would be a bigger hit because you'd be taking it all at once. Why we're going from 250 to 350 is looking at the demand for the program and expectations, wanting to keep up with $10,000 per home. I was asked in House General, well, wait a minute, by 2035, we don't know what home prices are going to be. What if people need 15,000? I mean, to say you're giving someone $5,000 now sounds like a 11-year-old number. 10,000 sounds more of the market. And so won't you be in a position in the future to need to give someone 12,000 or something? That may be the case, but I'm a lender and I'm financially prudent, and I'm not going to ask you for more than I need because I might need it in the future. I think we can try to manage this program, and 10 years from now, if we're still giving out $10,000 and that's not enough to keep the program running, I'll come tell you about it and you'll decide then if that's a priority or not. But that's 10 years from now. I hope you've built enough homes. We've built enough homes in partnership that home prices have leveled, and actually this is sufficient.
The biggest indicator would be on repayment would be interest rates dropping. So in your crystal ball,
Yeah.
so is your rate now? Was it at 6% or is it?
Oh, our interest rate right now,
Yeah.
about 6%. Yep. Maura Collins, who went to college to be a journalist for the record. So if we're comparing prognosis here, I think you have the training to look into the future better than I do even. But I do think that rates, Eastrise yesterday was at 5.875. They are dropping some. I do not go to conferences or read articles that tells me that we're going back to 4 or 5% even. I think people would like, I'm aware that there's certain leaders in this nation who would definitely like those rates to drop considerably. And I'm going to stop talking about that topic right now.
I actually remember when they were 11.
Yeah.
Yeah.
Oh, my in-laws bought their house at 18.
18.
Yeah. Yeah. It does change. And so, I can't really predict.
Anyone else? Thank you. It's a fantastic program and appreciate you coming in and telling us about it. And we will put it into our miscellaneous tax conversation. Thank you.
And I just should say, I have spoken to House General about this, and I'm hoping I'll speak to House Commerce. And so I would hope that maybe those committees might chime in on their feelings about it as well.
Appreciate that.
Thank you also for your amazing.
Oh, the housing data?
There's so much valuable data there, so I really appreciate it.
Yeah. This is a lot of hubris for me to just ask, but I am not going to be around the building a ton in the next few weeks. So was there any other questions people had for me just while I'm here, just for a moment, because I did talk fast?
Well, we've already, interest rates are doing.
Yeah, well, that's why I have lots
Figure
of
that.
opinions on how the world should work, but
That's
I'm sorry if you have other things you want to accomplish.
No.
Just look at the clock
We're
thinking.
15 minutes.
Yeah.
Well,
Yeah, Representative.
everybody's asking for down payments.
Well, it's still the standard 20% is the rule of thumb, and you need the private mortgage insurance or something, but there's government programs, FHA, rural development that can cover that. But our borrowers pay about 5% down.
5%.
That's typical.
Okay.
Yeah.
What are other states doing?
Hmm.
Hampshire, York?
Yep. I can't name the states that are doing it. I can tell you that we are very unusual. I don't know any other state that's funding it with a state tax credit. Some states are now getting into what this state has done, which is having a first generation home buyer grant program that is an appropriation, and Vermont has done that. We've had a first gen program since 2022. That means you have to be a first time home buyer, like this program. And your parents can't have owned a home when you were growing up, or you were a child in the foster care system. And so if you're a first gen buyer, like first gen college kids or something like that, we will give you up to $25,000 of a grant. And so that's where there's some state support that more and more states are doing. But most states that have down payment assistance through agencies like ours, they price it into the mortgage. This is why this is unique. You get the regular interest rate from us. I don't have to ask the borrower to pay for their own DPA. We're using the state's money for that. So that's why that wealth generation is so powerful. Most states will say, my interest rate is 6%. If you want down payment assistance to qualify for this mortgage, you need to pay me 6.15 or 6.25 for your mortgage over 30 years. So sometimes the lender makes out on that. They end up earning more than the homeowner benefited from it.
Because when you go to sell it, you get a premium, so that's how you pay for the extra money.
Say that again, I didn't follow.
Saying is a higher interest rate has a higher premium in the market when you go to sell it, so
Mhm.
that's where you get a premium from
Yeah.
whoever's buying securitized.
Yes.
investment.
Yep.
Anyone else? Yeah.
You have time. It's nice to take advantage of your presence. We've made very, very significant investments, and we also live in a constrained labor environment, and we still have just a desperate need for increased supply. When you look across all the investments we're making, which of them are making, they each have different ROI, which
Yeah.
ones are making the biggest difference for the value that we're
Mm.
investing?
I have 3 children, so I struggle to pick favorites. Can I tell you 2 stories? Because I don't know that I could pick. There's 2 things that are coming to mind that I would say. I like financially efficient investments. So I like it, like I would consider this, I'm not using the term perfectly, but I would consider this like a micro loan program. Like we're giving them $5,000, $10,000 and they're getting $75,000 of wealth. That's $15 for every dollar we gave them. So I like when the state can invest a little bit of money and get a big return. So I've been very impressed with the success of the VHIP program that is, and I know that's in the governor's budget to move into base, and I support that. I think that that's not a lot of money and we're getting a whole housing unit out of it. And I think it's redeveloping communities. I also, the state housing authority started up a mobile home, manufactured home infill program with the state. And they bulk purchased 100 homes in the last year and have been selling them for $97,000 to $110,000. I will tell you, I was suspicious of that program. Not because I don't like mobile homes or any of the folks involved. It was, I didn't think that the lenders were going to lend on a home ownership home that's on a rented lot, because that's tricky. What if the rent goes up for that pad? Or what if you lose your lease or something like that? I didn't think the lenders were going to be able to overcome that hurdle, but we have such amazing community lenders in the state, community banks and credit unions that they have done that, and they've created 20-year mortgages for those products. 30 years would be better, but we're working on it. So Those are both programs where it's a relatively small amount of money that has created a housing opportunity. So I like that because then our dollars go farther. I also will say,
I noticed that they're also, you don't have sort of one administrative model either, though. Like the tax credits that you came in talking about have like a very low administrative cost. And the manufactured home purchase program is actually like pretty complex for the state to be administering, right? And so I think it's interesting, like you're seeing that kind of return with two
Yep.
very different types of state involved.
That's a good point. Yeah, I wasn't thinking about that, but you're right. I also, and I was just in Senate Housing this morning, and I was talking about the investments made in VHCB to fund, traditional affordable housing do cost a lot because you get a lot in return. And what some of those one-time investments have done is they've allowed VHFA to access more money for housing in Vermont. So this is a different way of being efficient with our dollars. We could look at traditional affordable housing and say, gosh, it costs a lot of money to build that. But what that investment did, and I'm going to try to be high level, but the federal tax credits that are the biggest source of building rental housing in the state, there are certain ones where we have pretty much an unlimited ability to give projects tax credits. Some of the other ones that are more valuable, they're very limited. We can only do like 4 a year statewide. So it's very competitive. But there's another kind where we don't give you quite as much money, but we have lots of this money to give out. How do you get those tax credits then? That's the question. What do you mean you have it and you're not giving it all out? Well, to get those tax credits, the developer has to come to VHFA and finance a big chunk of that project with private activity bonds. And so they do that through a construction loan. They come to us, they say, can I have $10 million to build this building? That happens. Just using that source of money triggers us to be able to give them tax credits. And the tax credits will pay, if this is a pie chart, it's going to pay for 35% of the development cost. Then they got to go to HUD, they got to go to VHCB for state money, they got to do other things to fill in the rest of that pie chart. So it doesn't happen very often because filling in 65, 70% of a pie chart is hard and expensive. And for new construction, it's just out of reach. It's not going to happen. So we use those credits mostly on rehabs, renovations, keeping housing affordable, preserving it, perpetuating it. But when the legislature made massive investments in VHCB, all of a sudden VHCB could fill in more of that 70% of the pie chart because they had the money. So all of a sudden we could use these tax credits for new construction. So that means we were finally tapping into this largely untapped resource.
Federal resource.
And let me give you an example. When I say it's unlimited, it's not really unlimited. It's limited, but let me tell you the numbers. Between 2013 and 2021 or two, I don't have my slides open. I think 2013 and 2022, VHFA did not use $300 million of that private activity bonds that we were awarded. It just expired. It went away. Then I think it was 2021, because then in 2022, we started using all of what we were allocated.
Because of the COVID money or the other.
Because VHCB could make the deals work, so people would come to us and ask for this money and we could spend all that we had. Last year, it's a calendar year thing, and on literally midnight, December 31st, it expires like Cinderella. And we lost $11 million last year for the first time in 3 years. So that money, when I say it expires on December 31st, we actually can roll it forward for 3 years. So what expired on December 31st was 3-year-old money expired. I'm telling you, we are sitting on hundreds of millions of dollars right now that I want to spend and lend. I'm a lender, I make money off that. Like, we want the housing and all that. I'm sitting on hundreds of millions of dollars that I want people to apply to us for so that it triggers these tax credits, so that we can give them their 35%. I want to do this. But they are not wrong to not ask for it because the numbers don't work with this kind of lending alone. Because what am I offering people? Like a 6% construction, 6% interest construction loan. Like that's cheaper than you'd get from a bank. And so that it's good, but it's not free. You know what I mean? It's not like the treasurer's 10% money. It's not any of that. You still have to pay 6% on the money. And you can't, we don't have enough money to fill in the rest of that pie chart. So there are different ways to measure the efficiency of the dollars we spend. So efficiency is one of my 5 core values, I can tell you. So what are my favorite programs? It's ones that look at efficiency. But I define that differently in different ways.
Representative Maslin.
Yes, thank you. Fascinating. Can you make us an example of your pie chart that you've been talking about? I mean, I realize there may be different ways to draw.
Yep.
Somewhat generic or something. Some of us are visually oriented. It helps to see the picture.
I've done it before, yeah. And it's changed since the pandemic for the reasons I was just saying, but yeah, the state money used to be about 10% and then it grew to being about 20% of the pie and the feds and all, but yeah, I can provide that and I'll follow up with the losses.
Very helpful. Thank you.
Thank you so much for your time. Really appreciate it.
You,
But
yeah.
So we are done with testimony for the day. This afternoon, if folks can finish reading reports, let me know if there's reports that you think we should hear testimony on. And both the Education Committee and the Senate Finance Committee have heard testimony that might be relevant to us. So if you're scrolling through agendas and watching YouTube videos, let me know if there are things we should be duplicating here or just sending people links on. Thanks. See you Tuesday.